The Fed has two options: interest rates and money printing. That's literally all they can do, yet it's such a powerful set of tools. They can completely destroy the currency if they really wanted to. What we are seeing today is that the Fed has been slowly letting their balance sheet be weaned off, and the effect has been apparent. Without QE, the stock market will fall. You came here for the truth, so let me unveil that for you. Today we're going to look at what the Federal Reserve and other central banks are up to. I want to talk about the cashless society. I want to talk about inflation and so much more in this episode. Let's begin by taking a look at this. All right, you can see that over the previous months, the central banks around the world have started to either reduce their balance sheets or reduce the amount that they're printing. Okay, so we do see a drying up of liquidity. Clearly, central banks around the world are still printing money. That's obvious, particularly with Japan and others, but there's less of it out there. Okay, so that is occurring today, and they break it down in this excellent chart by Bank of America Merrill Lynch. Whether it's the Fed, which is in blue, the ECB, the BOJ, China, and so on, we definitely see that this has declined. Very, very significant numbers that we are seeing today. Now, it is very clear to me, although not to some other individuals out there, that the central bank's balance sheets completely correlate with the stock market, particularly with the US stock market. It's very obvious. You look at any chart, whether it's the G3 central bank balance sheet, whether it is, the G4, G5, and so on, where you compare that to the S&P 500, and to me, it's practically exact, all right? So if the central banks are then going to start pulling back on that, the expectation is for real people to come in and start investing. But they've been doing this for nearly a decade now. All right, so the market is used to and has priced in the central banks printing up money. Suddenly they pull that money away over the course of a few years. What do you think is going to happen to the stock market? Well, that pricing mechanism is going to be triggered. Suddenly we would have a catastrophe waiting for us. This isn't something that I've been formulating here. This is an absolute fact. It can only be sustained with central bank quantitative easing measures. Now, you might think to yourself, this is not going to happen. They're not going to crash. A crash will never happen. This time is different. I've heard that many times before. This here is really an opportunity for central banks to use this crisis for their own benefit. How incredible is it that we can create a crisis, then the people beg the central banks and the big institutions, Warren Buffett, and all of the so-called supranational elite that go beyond borders, pay no taxes, and so on, for them to start accumulating assets like never before and for pennies on the dollar. We're willing to give the individual like Warren Buffett a sweetheart deal on Bank of America shares because he bailed it out. That's wonderful. He helped us. Therefore, we'll give him sweetheart deals. Oh, the Federal Reserve wants to devalue the currency, but in doing so, they're going to be able to save this bank and that bank. Oh, that's amazing. Oh, what about Fannie Mae and Freddie Mac? They've got trillions of dollars of garbage loans on their books, but we don't want them to fail. So let's just make all the taxpayers pay that, and we will nationalize those institutions. Oh, how does that sound? Did you get to vote on any of this? Of course not. But as a result, you lose less of your sovereignty, you get this devaluation of your currency, and you get no assets, all right? So they, off of your back, they're getting everything. And that's the way it goes. This here is the Fed tightening cycle. I made reference to it in a previous video, but I didn't show the chart, but now I found it again. So this is the chart. This little dot here represents where they expect, this is Bank of America Merrill Lynch, where they expect this to get to before they have to then retreat before there is a crisis that occurs. So they're expecting that to be December of 2019. I'm not necessarily saying that. What I always thought was around the 3% mark, and based on this, I mean, it seems, hard to tell exactly, but around that territory anyway, so I wasn't far off. But that's my estimation, and it isn't the actual Fed funds rate hitting a certain level and that triggers somehow a crash. It's everything interconnected with it, because with the Federal Reserve, they're loaning out money and they are able to then, all the way down the line, everything that's affected by interest rates, which is essentially everything in the financial industry, and not even in the financial industry. I mean, just look at when you think about construction, if you think about real estate prices, everything's all interconnected, all right? So the reason I mention this, I think, is very, very important, because you could look at all the previous crashes and see every time this occurs, it's lower. It cannot get back up to the point at which it was before. So they start to raise interest rates, as you see in this case here, and at some point they stop and they really start to hesitate, and then before you know it, they're bringing interest rates down drastically. And this here is always too late, by the way, when they do so. The same thing is occurring today. So we're going at historically a very slow rate, but where are they going to go down? If it's 3%, last time around, I think the number was something like 5.6% at the peak. So this here, you would only have from 3% down. You would have to take that into the negative territory. Are they going to do that? Perhaps. Janet Yellen said she was in favor of that. Maybe we'll see that this time around. So this here, I think, is absolutely critical to understand that they cannot do this. And you have to, like, it really, really just, I feel like ripping my hair out sometimes. People think that they can control interest rates by entering this into a computer. Oh, we want interest rates to remain at 2%. That's what we set it at. They have to do open market operations. They have to print money. That's what that means. They print money in order to make sure interest rates stay where they are. They can't do that forever. They're destroying the currency, and you're seeing the dislocations occurring. People can't afford their homes. Look at what's happening. All right, now copper prices have long been thought to be a good indicator of what's coming, of economic conditions in general. Obviously, it's an industrial commodity. It's extremely important. This is how it has behaved, basically over the last year, but I want to focus practically around the same time as the stock markets have been falling. We see the general trend here has not been doing so well for copper. So that's something I think is very important to note. Yet another indicator. Industrial commodities are huge to be following if you are looking after this. Yes, I realize that there are particular stocks that are doing better than they were back in January. I get that. However, we need to look at real indicators in order to measure this. That's what I'm doing. I'm tracking the progress here. Okay? I'm not making predictions. I'm simply tracking the progress. All right. Now, the cashless society is quite interesting because they're obviously going for it. It's very clear to anybody. And I definitely see the benefits of it in terms of the user experience. So, you're traveling, you're going from one place to another. You don't want to carry around $10,000 with you. You can have that in a bank somewhere, and then you could use a piece of plastic, and that's beneficial to you. Okay, you get that plastic. If somebody steals the plastic, you call the company, say someone stole it or I lost my wallet, cancel the card. Okay, so benefits, they're clear, they're very obvious to me, but you definitely lose in other ways. Okay, so we have this problem that by using these means, they're able to track us. When you use the loyalty cards, they track you, all these things. Okay, Forgot your bank card? No worries, Chase has you covered. The New York City-based bank announced that it has expanded its cardless access to nearly all of its 16,000 ATMs nationwide. The new technology will allow customers to get cash through their phone's mobile wallet without needing a physical debit card or access code for authentication. Tap their smartphone on the ATM and you get your money. Okay. Like I'm saying, it's convenient. It's very clear everyone's carrying a cell phone these days, so that's a good thing for people to be able to get their money. But it's still a very, very big concern, because as the cash moves out of the hands of individuals, a lot of places are going with their whole interface is basically just an iPad, and they don't even take cash. So what are you going to do? If you have cash, well, you can't use it there. So you have to go to another business. Sometimes, that can be a little bit difficult if you're traveling or things. But I thought that this was just important to see where the technology is going. New people that are coming in today, they're younger people. They're used to this. They're used to the plastic. They're used to the cell phones, paying with cell phones. They will be anyway. And this is going to be something that is becoming more prevalent. So that's the direction that I see. All right, the price of a can of Coca-Cola likely going up. A package of Pampers, that too. Plane tickets, they also be more expensive. These items and more may cost more in the coming months as people start feeling the effects of higher fuel prices and raw material costs, as well as a range of tariffs. Everything's going up, and this right here is an incredible line. I think it's amazing. This is just an individual. What she said: the economy is doing great, so why is everyone doing so poorly? And that really says it all. It takes me 10 minutes, 15 minutes sometimes to get through the video, and I can't say it even as clearly and succinctly as this woman here. So congratulations, or kudos to you, I should say. The Consumer Price Index, the government's primary measure of inflation, rose 2.9% in June from a year earlier, the fastest increase in 6 years. All right, so they're talking about cutbacks, they're talking about everything and how these companies are being affected by all the tariffs and the new expenses that they're facing. I get it. All I gotta say is that there is no way to deny what is happening today. We are feeling the effects of inflation, but it's not direct. Okay, it's not just gonna happen one day you wake up and you're using a wheelbarrow of money. It doesn't occur like that. But it does happen when you least expect it and where you can't see it. Amazon has declared its lowest UK corporate tax bill in 5 years as the web giant was accused of killing the high street. The online retailer paid $4.6 million last year, or just over 6% on its profits of $72 million. Now, how does that sound to you? Would you like to pay 6% tax? That would be pretty nice, right? Well, you can't. You're not Amazon. Too bad for you. All right, that's all for this video. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, it helps to support the channel. I do appreciate that very much. I'm being squashed down, so when you give me a thumbs up, when you comment on the videos, you're helping me push back up against that resistance. So definitely appreciate that. And my friends at Amazon will host these 2 books for me. I can badmouth them and promote them in the same video. This is basically my 2 books that I teach everything about the financial system, where you don't need to know a single thing about it and be able to actually learn everything you need to manage your own money. So I'm really proud of these 2, and you can get them at the link in the description. But if you're more interested in the audiobook version, you can get that at themoneygps.com.